Welcome back, options traders, and happy Friday to everyone. I received an email from a trader, and this is a question that you do get a lot from new traders, but it might seem pretty basic, but it's absolutely a very good question for all of the new traders out there. The question is, does an option need to go in the money to be profitable? So if you buy a $100 call, is it absolutely essential for the stock to get over and above 100? Is that kind of what the game is about, that you need this stock to get above 100 before it's profitable? So it might sound like that's the way that options work, but it turns out it's not. But let's go find out why. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So in the money versus out of the money. Remember that in the money options are worth intrinsic value at expiration. Out of the money options are worthless at expiration. But prior to expiration, out of the money options have value. That would actually be too good of a deal if people were giving away out of the money options for free. So just the fact that there is time remaining and possibly a lot of volatility, the crowd, other traders are saying, you know what, there's a pretty good chance that this option could end up having intrinsic value. And so that's what they're really paying for today, is the fact that there is a decent chance. Now, of course, the closer the stock is to this out of the money strike, all things being equal, then the more value that option will have. So, for example, we've talked about bell curves before, and remember that for every single stock price, there's an imaginary, kind of an implied bell curve sitting directly over that stock price. And we know that in this blue area, there's about 68% of the probability, or 68% of the data will fall within what's called one standard deviation. If you look at the blue plus gray, that is 95% of the area. And then finally, if you look at the entire bell curve, including those red tails, that's almost 100%, about 99.7%. So always remember, and this is important for understanding why these out of the money options can have value, that those standard deviations just keep going. There's a fourth and a fifth and a sixth. Their probabilities are so incredibly small that they're generally not worth talking about. But the point is that the bell curve is not just chopped off right here at the end of these red tails. And so as that bell curve moves, or as that stock price moves, the perception of this option being able to go in the money increases. So for example, let's start with an at the money option. And so if we have the stock price right here in the center, we can see that there's about a 50% chance for the stock price to be to the right of the center, or in the blue area, and a 50% chance for it to be to the left. So if you have a call option, there's roughly a 50% chance that that stock price will be to the right, or meaning that that option will be in the money. Now, it's also not correct, even though you'll hear a lot of people say this, that an options delta is the probability for the option to go in the money. It's close, but in some cases it can be grossly off. But it's still not a bad estimate most of the time. And if you know a little bit about options, you'll know that the at the money strike has a delta roughly equal to 50. But here's the thing to understand, that as the stock price moves, let's just look at it rising for right now, that bell curve always stays above the current stock price. So when that happens, now we've picked up some additional area out here. So now we're saying, all right, it used to be a 50% chance for this option to be in the money. Remember, that strike was down here, but that bell curve is now moving to the right. So now we have the probability of the blue plus the red. And if the stock moves more to the right, now we get the blue plus the red plus the green. We're filling in more of this area under the bell curve. And so market participants are saying, yeah, it still might be somewhat of a long shot, but it's certainly not impossible. And it's becoming better each day. If the stock continues to move higher, now we might get the blue plus the red plus the green plus the yellow. And we can see that eventually, as that stock moves, that it will move so far in the money that this entire bell curve becomes filled in. In other words, that strike price is way down here somewhere. And when that happens, the market is saying, all right, yeah, no matter what happens to this stock, this call option will be in the money. and that's when the delta will be 1. So that's how it works most of the time. We'd like to see that option start gaining intrinsic value because at expiration, you do not lose the intrinsic value. So that's certainly the best case. But prior to expiration, if you have an out of the money option, what you really need is fast, aggressive moves. So if the stock makes fast, aggressive moves prior to expiration, out of the money options can become highly profitable. Now, by fast, it means like right now, not next week or 6 months from now. We need it to be a fairly quick response. And then aggressive means not only does it need to be now, but we're not talking about a few pennies that the stock went up. So maybe by tomorrow or 2 or 3 days from now, the stock goes up 2 or 3 or 4 points. And you're going, okay, well, that's a fast, aggressive move. And if that happens, especially several days, even though it's still an out of the money option, it can really pick up a lot of value. Also remember, as we talked about in a previous video, about the leverage. The out of the money options have the greatest leverage. So yes, you can see very big changes in the values of these options. So the thing to understand is that options do not need to go in the money to make money. But in order for that to be true, you are going to need fast, aggressive moves in the stock. So this also sheds some light on why you might use an out of the money option. You should not buy an out of the money option just because it's cheap. That's a big mistake that a lot of traders do. They'll say, well, this out of the money option is only 20 cents or 30 cents. And so the most I can lose is that 20 or 30 cents. So they think it's low risk. But remember, risk is about the probability of loss. Those are virtually guaranteed to be losers unless you are expecting fast, aggressive moves. And if that's true, out of the money options can be a very good choice. Just remember that this only works for so long. It doesn't matter if the stock is making fast, aggressive moves. If it's still an out of the money option at expiration, then that option loses 100% of its value. So you would definitely need to cash in before that time unless you really thought it was going to pick up intrinsic value. So again, to kind of see that graphically, let's say that we have a stock at 100 and you buy the 120 call. So the strike is out here. Now remember, over the current stock price, there is an implied bell curve. You're obviously not going to see it, but mathematically it's there. That's just saying that based on a certain volatility, there's a certain range that we would expect from the stock. And now if the stock moves up, then this entire bell curve will shift to the right. And so we're going to see something like this. Now notice when that happens, this area over here is starting to get closer or covering more area over this 120 strike. So it's still an out of the money call because the current stock price is right here. It's well below 120, but it's moving closer. And so mathematically, what's happening is that traders are saying, you know what, there's a somewhat decent chance for this to become in the money. Not a very high chance, but it's certainly not zero. Stock moves up some more. We're still out of the money, but we're going, you know what? Now we might have a 40% chance for this to go in the money. And so if the option was worth close to zero back here, it's definitely not worth zero now. So think about it. If an option goes from a value of 5 cents to maybe 15 or 20 cents, well, that's now a 3 or 4-fold increase. Now, that doesn't necessarily mean that the out of the monies are the best to trade. They're generally going to have wide bid-ask spreads. There's other problems that can happen, but still from a percentage standpoint, they can pick up a lot of value. Now, another thing that can happen is a volatility increase. In the previous slides, we saw just the stock price rising. But we could also have volatility increasing. So as volatility increases, the chances for an out-of-the-money option going in the money increases, and therefore it will increase that option's value. And the reason for this is that the bell curve is getting flatter and wider. So we can keep the stock price the same, but if volatility increases, and all it takes for that to happen is that traders perceive that there's now a better chance for it to move. So maybe there's a buyout rumor, or earnings are coming up. And traders are willing to pay more for these options. That's really what's increasing the volatility. And that's going to give those out of the money options value, even though they don't have intrinsic value. So, for example, let's go back and say here is our $100 stock, here's our $120 call. Bell curve sits over the $100 stock. It's possible that the stock price doesn't even move, but traders start sensing that the volatility will rise. Again, it could be a buyout rumor, an FDA announcement, something like that, where traders are going, yeah, it's out of the money, but because of this impending news, it could potentially go in the money. And the way we show that graphically is that the bell curve is going to get shorter and wider. And so now you can see that this 120 call is starting to pick up some of this area under the bell curve. So whether you have the stock price rise or volatility increase, what you're really doing is just increasing the area under this bell curve for that strike. And of course, the more area that's put up under this strike, the more valuable the call becomes. So if you get an increase in volatility and the stock price moving in your favor, that's when they can really explode in value. So let's go over to a pricing model and take a look at some examples. All right, so now we're into a pricing model. This is over at barchart.com. I'm going to use the underlying price, the stock price at 100, strike at 120. This is what we saw in the examples. Days to expiration, 90, risk-free interest rate we'll put at 0, and volatility is here at 20%. I'm also going to make the dividend yield at 0, and with those parameters, the theoretical price is 14 cents. So the question is, can this have value without going in the money? Well, we still have 20 points to go before this option's even going to be at the money. And yeah, it's a long shot. So why would people buy this? Well, for one, you might be looking for a fast, aggressive move. So let's say maybe in the next 5 days, so let's knock this down to 85. So we lose 5 days of time, but the stock goes from 100 to maybe 105. All right, and what happens now? Well, now it's a 41-cent option. Yes, it'll be worth 0 if expiration is today, but right now it's gone from 14 to 41. Let's say it maybe goes up to 108 in the next couple of days. So we'll knock off 2 more days. We'll put this at 83. See, now it's a 74-cent option, but it's making a fast, aggressive move. So you can see that if we get closer to 120, let's put it at 112. Now it's a $1.52 option. So again, the thing to remember is that yes, you could close it right now. You paid 14 cents. You close it out at $1.52, highly profitable. But if it takes all the way to expiration for this to happen, back at 0, what happens? See, it expired worthless on you. So that's where a lot of traders get confused. They say, well, it's out of the money. There's no intrinsic value. But what they're failing to recognize is that there is value prior to expiration. Okay, so that was our first example with the stock price moving, a fast, aggressive move. Let's go back to the settings that we had here, 14-cent option, but let's increase the volatility. I'm going to keep the stock price the same for right now. If we put volatility, let's say, maybe to 30%. See, now it's an 87-cent option. That's a big jump, especially in percentage terms, even though the stock price hasn't moved. Again, maybe this could happen for a biotech company, for a phase 3 trial, or a highly anticipated earnings announcement. What if we go to 50% volatility? Look at that. It's worth $3.65, even though the stock hasn't moved. So even if it takes some time for that to happen, let's put this down to 80 days, 10 days goes by, still a $3.19 option. See, so yes, these can be very profitable even though they're not in the money. Now, what if the stock price moves and volatility rises? So we got this bump up to 50%, but the stock is at, let's say, 110. Still an out of the money option, but look at that. Went from a 14-cent option to 644, but that's also now because we're looking at a fast, aggressive move in the right direction and an increase in volatility. But always remember, yes, it is true there's no intrinsic value, so if this happens At expiration, it's worth zero. So we do need this to occur prior to expiration. That's really the key. So I hope that helps to answer the question. No, you do not need an option to go in the money to be profitable. You need either a fast, aggressive move in the stock or an increase in the volatility or both. But as long as your option is out of the money at expiration, it will be worthless. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.